So, dear class, welcome to our today's session. We're going to start. And the area of study today is the evaluation of share in a supernormal growth firm. I hope you're able to keep track of how these things are done. Evaluation of share, evaluation of audience share in a supernormal growth firm. This is financial management. Financial management. Valuation of share or valuation of shares in a supernormal growth firm. Valuation of shares in a supernormal growth firm. Class, this is where we're going to look at how do shares grow when we are to get a great profit or a supernormal profit, whereby you find that the product in that organization is highly, it has high demand. The product is having a very high demand. So that means if the product is having high demand, I expect that the growth rate will go up. The product is having high demand, growth rate will be up there. But after some time, the demand will tend to reduce. And the rate or the growth rate will decline. It will decline to a certain level. After which it will stabilize. Into perpetuity. It is like the business, the way business grow. You see, if you start a business today, or if you have a new product and you market it very well, people will tend to use it. People will tend to test your product. People will tend to test your product to a certain level. So they are testing it. The demand is very high. It will get to a point whereby these people will find that the product will be needed to be common. It's just common. It may decline to a certain level. After which it will stabilize. Into perpetuity. It will stabilize into perpetuity. Good. Now we write and say, in this case, dividends are expected to grow at a very high rate. Dividends are expected to grow at a very high rate in the initial stages of the farm. Dividends are expected to grow at a very high rate in the initial stages of the farm. Full stop. This is because of the high demand of the farm product. With time, next point, with time, the growth rate in dividends is expected to decline. The growth rate in dividend is expected to decline up to a point where it will stabilize. I repeat, with time, the growth rate in dividend is expected to decline. With time, the growth rate in dividend is expected to decline up to a point where it will stabilize. 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 And dividend will grow at a constant rate throughout. And dividend will grow at a constant rate throughout. And dividend will grow at a constant rate throughout. Same way. Very high. And then decline. Then it just stabilize to a constant rate throughout. NB. The intrinsic value of ordinary share in a supernormal growth firm. The intrinsic value, remember, whatever that we are looking at is the intrinsic value. What is the value of that ordinary share? Right? The intrinsic value of ordinary shares in a supernormal growth firm. The intrinsic value of ordinary share in a supernormal growth firm is therefore the total of the present value. Is therefore the total of the present value of expected cash flows. The total of the present value of the expected cash flows. The total of the present value of the expected cash flow. I want you to have that. That is important. The total of the present value. So that means we're going to discount the expected cash flow of the expected what? Expected cash flows. And this cash flow, they're in form of dividend. Of course, that is dividend is what we expect. Yeah, I'm going to repeat. Dividend is what we expect from the firm, where we are members, the shareholders. We expect dividend. That is the return that we expect. That is the cash flow. So we're going to discount the present value of that, or to get the present value of those cash flow. Of course, the expected cash flow or dividend. So repeat that statement again. NB, the intrinsic value of ordinary shares in a supernormal growth firm. The intrinsic value of ordinary share in a supernormal growth firm. In a supernormal growth firm is therefore the total of the present value. Of expected cash flows. The total of the present value of the expected cash flow. You see, we are having a different growth in dividend. Shares. Shareholders do subscribe so much when demand is high. They subscribe at a very high rate. The growth is very high. Then after some time it will decline. After which it will stabilize at a certain rate as well. So all through, we are going to have the dividends. Dividend for the highest rate, dividend for the middle rate, and then dividend to perpetuity. So that means the last dividend will be to perpetuity. The last dividend to be earned will be to forever, to perpetuity, infinity. To be into infinity. I'll show you how to compute that dividend to infinity. So you will add all of them, of course, all of them. They're getting the present value, and then you do what? The total is the intrinsic value. It's a very, very interesting area. So A, after you write your expected cash flow, have part A, have A. So under part A, we say that present value of expected dividend, present value of expected dividend, present value of expected dividend, present value of expected dividend tulisema ni D1 up to point of stabilization itapeanwa hivi. Up to that point tutakuwa tunatumia D1 is equal to D0 1 plus G. So that is part A. So tunasonga up to the point of stabilization. So if you've been given year 1 to 4, the rate is 20%. The growth rate, dividend growth rate is 20%. Year 5 to 7, the growth rate is maybe 15%. It has reduced to 15% from 20 to 15. And then thereafter, year 8 to infinite, and the other year to infinite, it will be stabilizing. It will be stabilizing. It will be stabilizing. So for year 1 to 5, then year 6, year 1 to 4, year 6, let me just write it here. Year 1, 2, 3, 4, 5, 6, 7. I'll be having the first rate, year 1 to 4, 20%. Year 5, of course, to 6, it will be maybe the 2 years in Sawa, 15%. And then year 7 to infinite, this is what? Where it is stabilized at a rate of maybe 10%. Rate of 10%. At a rate of 10%. Now, in this case, we are going to have this one, the present value. Of course, you get the D1. You get the D1, which is D0. D1 is given by D0. Let me give you a great formula here. D1 is equal to D0 1 plus G. So this is what we shall be getting here. We shall be getting expected dividend for year 1, expected dividend for year 2. Of course, you will be given by the examiner D0. Examiner will give you D0. The current dividend. Current dividend, you can now share a photo of where you started. So we need can be assisted. So the current dividend here. Current dividend. So this current dividend, the first year I'll be having the one, my expected dividend here. At the end, after doing that D0, I grow it. Then the second year, my current dividend will be what I've gotten. What I've gotten as the expected dividend for year 1. It will be the current dividend, like that up to this point. The 20% will be for 4 years. 15% will be for 2 years. And then to infinity, you usually get the current or your D1 in year 6. So to get the year 7 to infinity, we usually take the D6, whatever that we shall be having under D6 hapa, and then you grow it 1 plus G, and then you divide by what? KE minus G. KE will be the total cost of capital or the required rate of return. That is what we are going to do. So for A, D0, you grow that. You grow that to get D1. Then you have B, at B here. B, you say that present value of shares, immediately after stabilization point. Immediately after stabilization point. So this is where now we bring this one. Immediately after stabilization point, this is where now we bring this one, whereby we say that PO, or that value will be equal to D1 divided by KE minus G. KE minus G. Remember D1 is the same as what? D naught 1 plus G. So it's this formula. That formula is the one that we are going to use. Very, very important. Very important. Please confirm whether we are together before we now do a question for more understanding. For more understanding. Are we together? Are we together? All right. So illustration. Let's have an illustration. It's just a simple thing, a simple one. Illustration. We have 𝐬𝐞𝐬𝐬𝐢𝐻 Limited. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company which intends to be listed in the Securities Exchange. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company which intends to be listed in the Security Exchange. 𝐬𝐞𝐬𝐬𝐢𝐻 Limited is a private company which intends to be listed in a Securities Exchange. Full stop. Full stop. The company has recently made a dividend issue. The company has recently made a dividend issue of 3.2 shillings per share. The company has recently made a dividend issue of 3.2 shillings per share. 3.2 shillings per share. Full stop. Then you continue and say, this dividend is expected to grow at a rate of 15% per annum. I want to repeat that statement so that you get it clear. I want you to get this clear. The company has recently made a dividend issue of 3.2 shillings per share. A dividend issue of 3.2 shillings per share. Full stop. This dividend is expected to grow at a rate of 15% per annum. Very high rate. Expected to grow at a rate of 15% per annum. This dividend is expected to grow at a rate of 15% per annum for 2 years. 15% per annum for 2 years. And then drop to 12%. So the first rate is 15%. First rate is 15% per annum, 15% for 2 years. And then drop to 12%, 12% per annum for the next 3 years. Is it? Yeah, 12% per annum for the next 3 years. For the next 3 years. In a drop from 15, just drop to 12. Full stop. Full stop. Thereafter, the dividend will grow at a rate of 6%. Thereafter, the dividend will grow at a rate of 6%. Thereafter, the dividend will grow at a rate of 6%. Asilimia sita. Asilimia sita. Asilimia sita. Thereafter, the dividend will grow at a rate of 6%. The dividend will grow at a rate of 6% per annum indefinitely. That means into perpetuity. The dividend will grow at a rate of 6% indefinitely. Full stop. The required rate of return is 11%. Hiyo ni cost of capital. Cost of capital ni 11%. Cost of capital ni 11%. The required rate of return is 11%. Required. What? The intrinsic value of a share. Now the question. So can we get the solution to the question? Can we get this solution? Can we get the solution to the question? Can we get the solution? Of course, together. You're getting it together. Not you're not getting it alone. You're getting it together. Can we proceed? Yes, you're getting it together. We just get the solution together. Great. Now, solution. So solution. Now, the first thing, we identify the number of years, or the years that we have. Years. I have year 1, 2, 3, 4, 5, and then 6 to infinite. Then my D1 is equal to D0, 1 plus G. 1 plus G, and then I can have PVIF 11%, that factor to discount. And then I have my discounted cash flows. The total of the discounted cash flow is what we need at the end of the day. So niko na hizo items like that. So I just start with the first item. D0 is 3.2. I grow that by 15%. The first 2 years, we are growing that by 15%. It will be 1.15. So how much is my expected dividend for year 1? How much is my expected dividend for year 1? Gapi, you grow it with 15%. 1 plus 15%, it will be 1.15. How much? You grow that 3.68 from Quinta. Great. So this is our expected dividend, 3.68. Now, if this is the expected dividend at the end of year 1, it is like the balance carried down. So this is what will be the balance brought down in the year 2. Balance brought down. So our D0 now in year 2 is this one. True or false? True or false? True or false? It will be our balance brought down. So you just pick this one. You bring it here. You grow it with the same rate. 6.8. We grow it with the same rate of 15 because it is year 2. We get it. Let's get that. 4.23. 4.23. Tunarepeat tu hapo, tunakuja tunaweka hapa. That will be our D0 in year 3. 4.23. You grow that 1.15. 1.15. Na sasa ukiwa na hiyo, now our rate has changed from year 3 to 5. The rate is 12%. 12%. This was 15%. So this is now growing. Whatever. No. I should also change here. This is 12, not 15. Don't make that mistake. That is 12. Yes, that is 12. Yeah. It is 12. It should be 12 now. Work with 12. Work with 12. Our rate from year 3 to 5 is 12. It is 4.23 is the one that you are listening to, or you are increasing by that. It's 4.74. Don't use 5. It is 4.74. And 4.74, we grow it 1.12. Kwa ngapi? I grow that with the 1.12. itakuwa ngapi? 4.74, you grow by 12%. 5.31, then 5.31 we grow that with 1.12. Hiyo ni ya mwisho kwa hiyo line. 5.31 you grow it with 1.12. 5.95. Now, for our infinite, this is where now this formula comes in. Formula comes in. For our infinite, that formula comes in. So I want somebody to tell me my d, hapa tutakuwa na d what in this case, in this in the case of this example. Hapo d yetu itakuwa d what? D what? Because you'll be given several different years, eh? Yeah, itakuwa d5, eh? d5. Yani tutatumia hii. Tutatumia hii, eh? Tutatumia hiyo. Hiyo ndio itakuwa kama wa d not, eh? D not our d not hapo. So it will be 5.95, and the rate we are growing by 6%. 6%. So 1.06 divided by KE is 11% minus 0.06. So here, since it is going up to infinite, you just it is the biggest. Ndio inakuwa biggest kwa hizi zote. It is the largest. Na nipatie hiyo, just work on it. Work on it. Work on it. How much are we getting for the infinite section? $126.14 from Quinta. 126.14. 126.14. Great. Yes, that is it. Then we have our PVIFs. PVIF 1 year, 2 year, 3rd year, 4th year, 5th year. Remember, NB, to get the PVIF for this part of our infinite, we usually drop the PVIF for the previous year. In our case here, we shall drop the PVIF for year 5. That is what we drop here. We shall drop it. Drop, drop, drop. Drop, drop. PVIF for the infinite figure, we drop for the previous year. If I have 9 years or 10 years, I'll drop PVIF for the 9th year. If I have 20 years, I'll drop the PVIF for 19th year. If I have 30 years, I'll drop PVIF for which year? I want you to understand your drop for PVIF. Muhimu. If I have 40, I'll drop the PVIF for 39 there. Yes. So tunamaanisha kwamba the rule is the infinite part. Remember, we're looking at the present value interest factor, interest factor. Year 1, 2, 3, 4, 5, we're going to find it normally. But when it comes now to the infinite, we drop the PVIF for year 5. In this case, because we are having up to 6 years to infinite, so we drop for the previous year. If I have 10 years, I'll drop PVIF for the 9th year. If I have 7 years, I'll drop PVIF for the 6th year. So let's get the PVIF for year 1 to 4 decimal places. Then I show you how we drop. So that the drop thing, you need to just get it. Get the drop part. The drop part, you need to get it. Haya, tupatie ya kwanza to 4 decimal places. 1.11 raised to -1. 1.11 raised to -1. Hiyo ndio ya kwanza. 9009. 9009. Ya pili, pate ya pili saa tukisonga like that. 8116. Ya tatu 7312. Ya nne you can look at the table, or else you can use your calculator. Table, does the table has 11% leeway? I think you use your calculator. Haya, ya tano 59 35 59 35. Sasa hapa ndio huwa tunasema you drop. So hapa tutakuonyesha hivyo you drop. So that is the what we use there. Tafadhali, most people usually miss here. Unakuja unakuta unaitafutia ati sasa sijui nasema 1/. Hapana, hiyo kumbuka hii ni PVF. This is a PVF, dealing with a PVF. So that is a rule. You drop that. So let's now get the discounted cash flow. You take this one times this. The first one itakuwa ngapi? Maybe to 4 decimal places if you wish. Kwanza itakuwa ngapi? Now we are multiplying the dividends times these 3.3153. 3.3153. Ya pili, this times this, like that. Ya pili. The second one itakuwa ngapi? 3.4333. How do you get? Yes, Deborah. It is the whatever the result that we've gotten here, which is our dividend times the PVF. Yes, times the PVF. The dividend times PVF. So, for instance, 3.68 times 0.9009. You get that. Try that. So tupate hii ingine ya tatu, ya 4, ya 5, ya 6. Tupate hizo. Ya tatu ni ngapi? 3.4659. Ya 4, the fourth one. Ya 4. 4977. Ya 5. Before you go to the last one. Ya 5. Is it going to 5? A 4 point something? Or still 3 point something? Ya 5. Hapa. This times this. 3. Imerudi nyuma. This one. 5.93 times 0.59. Oh, okay. So we move with it. Because of the rate has reduced. 5313. 3.5313. Oh, it was still due. And then the last one, it should be the biggest. It should be the biggest. 74.8641. 74.8641. So you to do your rule unafaa kushika hivyo. And then total of these give you the intrinsic value. Intrinsic. Can you get that? Intrinsic value. Total of those. How much is the total there? 92.1. 92.1 from Sharon. Sharon tupatia 92.1. 92.1. 076. That is very okay. So that's how we do it. So the tip is, remember to get the infinite value in that using the formula. Remember to drop. But other things equal direct. Or direct. Can I give you one to do? Can I give you one to attempt? Okay, so we have one. At least you attempt, we see how far you can get. So ZD Limited is forecasting a growth rate of 12% per annum. ZD Limited is forecasting a growth rate of 12% per annum. 12% per annum. for the next 2 years. For the next 2 years. It's forecasting a growth rate of 12% per annum for the next 2 years. Full stop. The growth rate is likely to fall to 10%. The growth rate is likely to fall to 10% per annum. 10% per annum for the third and the fourth year. For the third and the fourth year. Third and fourth year. The growth rate is likely to fall to 10% for the third and the fourth year. Full stop. After that, the growth rate is expected to stabilize at 8%. After that, the growth rate is expected to stabilize at 8%. The growth rate is expected to stabilize at 8% per annum. Full stop. The growth rate is expected to stabilize at 8% per annum. Full stop. 8% per annum. Full stop. The company has just paid a dividend of 1.5 shillings. DO is equal to 1.5 shillings. 1.5 shillings per share, and the investor per share. Per share, and the investors' required rate of return. 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 Investors' required rate of return is 16%. Is 16%. Asilimia 16. Investors' required rate of return is 16%. Required, determine the intrinsic value of share. So I'll repeat the whole thing. You just cross-check what you have. You cross-check what you have. Z Limited is forecasting a growth rate of 12% per annum. Forecasting a growth rate of 12% per annum for the next 2 years. For the next 2 years. Weke full stop. Weke kikomo. Weke kikomo. Weke kikomo. Then you continue. The growth rate is likely to fall. It is likely to fall to 10% for the next, for the third and the fourth year. It's likely to fall to 10% for the third and the fourth year. Uweke kikomo. Then you continue. After that, the growth rate is expected to stabilize at 8% per annum. At 8% per annum. Full stop. The next part. The company has just paid dividend. The company has just paid dividend. Here is current dividend of 1.5 shillings per share. 1.5 shillings per share. And the required rate of return, or the investor's required rate of return, is 16%. Investors' required rate of return is 16%. Required. Determine the intrinsic value per share. Determine the current intrinsic value of the share. Intrinsic value of the share. So kindly attempt that. Attempt that. It's just a simple one. Just attempt that. How many minutes should you? Oh, no worries, JM. Yeah, you're going to, the class will be uploaded. The class will be uploaded. So Erastus is saying that within 5 minutes, you guys will be done. So from my watch here, it is 5:57. 5:57. So we can combine that with a short break of 3 minutes. So by 6:05, you guys should be done. Should be done. 6:05, you guys should be done. We forgot to record, eh? Allah. Thank you so much, Doruja, eh? So I have to repeat for you, eh? I have to repeat the statements from the start. Yes, 𝗞𝗔𝗦𝗡𝗘𝗕 this is Frida Limited, generated 50 million shillings profit after tax in the previous financial year. The firm adopts 40% payout ratio as its dividend policy. The firm adopts 40% payout ratio as its dividend policy. The total number of issued ordinary shares, are 10%. The total number of issued ordinary shares are 10 million, not percent, but 10 million. The total number of issued ordinary shares are 10 million. Full stop. The company has a potential investment opportunity. The company has a potential investment opportunity. Full stop. If undertaken, comma, if that investment opportunity is undertaken, dividends are expected to grow at the rate of 10% each year. Dividends are expected to grow at a rate of 10% each year for the first 3 years. For the first 3 years. The rate, at a rate of 10% for the first 3 years, and then stabilize, at the rate of 5% each year thereafter into perpetuity. The investor's minimum required rate of return is 18%. The investor's minimum required rate of return is 18%. Required. Determine the current intrinsic value of the shares. We have said that the trick in that question was to get the DO or the DPS, dividend per share. And that one is given by the total dividend divided by number of shares. Plus, how do we get total dividend? Total dividend paid. You've been given the payout ratio, right? You've been given the payout ratio. And the profit after tax is 50%. And the payout ratio of 50,000 or million. Sorry. So 40% of 50, that is what was paid. Takuwa ngapi? 40% of our profit. Takuwa 20 million. 20 million. So if this is our total dividend paid, 20 million, and we have the total number of shares, is it possible for us to have the DO or D note? Yes, because we have to fit just the formula. DPS is equal to the 20 million divided by number of shares, which is 10 million. So itakuwa 2 shillings per share. Shilingi mbili. So that is our, hiyo ndio ilikuwa 2 separate, shilingi mbili. 2 shillings per share. So with that, you can drop the question very fast. Just finish up the question. Now we're looking at the speed. Who will be the first one to finish? Tushamalizana. Hiyo ndio ilikuwa tu area tough. The others kawaida. Haya, sasa wacha tuone. Please make sure that at least you get it. Let's finish up that. And then I'll give you one for assignment and we call it a day. Then in our next lesson, we're going to look at the valuation of shares, a valuation of right issue, and also valuation of what? The mutual funds. So we're almost done with this topic. And see, yeah. So finish up that. Safaricom Limited's earnings have been growing at the rate of 18% per annum. Full stop. This growth is expected to fall or to continue for 4 years. Safaricom Limited's earnings have been growing at the rate of 18% per annum. Full stop. This growth is expected to continue for 4 years. This growth is expected to continue for 4 years, after which the growth rate will fall to 12%. So inatoka 18 ina fall to 12%. The growth rate will fall to 12% per annum for another 4 years. For another 4 years. For another 4 years. Full stop. Thereafter, the growth rate is expected to be 6% in perpetuity. Thereafter, the growth rate is expected to be 6% in perpetuity. Full stop. The company's last dividend paid, was 2 shillings. The company last dividend paid was 2 shillings. The company last dividend paid was 2 shillings. Full stop. The investor's required rate of return is 15%. The investor's required rate of return is 15%. Required. Determine the intrinsic value of the share. So I'll repeat the statement, the whole question. I'll repeat the whole question. I know you've written something, but I'll repeat. So have we given the required rate of return? 15. 15%. 15%. The investor's required rate of return is 15%. So I repeat the whole statement. Pole. Safaricom Limited's earnings have been growing at the rate of 18% per annum. 18%. 18% per annum. The top there. This growth is expected to continue for 4 years. This growth is expected to continue for 4 years, after which the growth rate will fall to 12%. After which the growth rate will fall to 12% per annum for another 4 years. Miaka ingine ngapi? 4. Full stop. Then, thereafter, the growth rate is expected to be 6% in perpetuity. Thereafter, the growth rate is expected to be 6% in perpetuity. Full stop. The company's last dividend paid was 2 shillings. And the investor required rate of return is 15%. The investor required rate of return is 15%. Required. The intrinsic value per share. The intrinsic value per share. The intrinsic value of audience share. The intrinsic value per share. The intrinsic value per share. So class, please try that. Try that. And when we meet next, we are going to start on valuation of mutual funds. Valuation of mutual funds. And then valuation of right issue. Valuation of right issue. Tufanye math kidogo hapo. And we will be done with that topic. Then we go to topic number 6, which is the introduction to capital structure decision. 6% to perpetuity sum. 6%. So we've said that next time we meet, we're going to look at valuation of mutual funds. Then valuation of right issue. Tufanye math kidogo hapo. Calculation kidogo. We'll be done with that topic. Then we start topic number 6, which is introduction to capital structure decision. Introduction to capital structure decision, where you'll be able to learn about the weighted average cost of capital weighted marginal cost of capital, and we're going to see all the steps that are followed for us to be able to do that. But for today, let's widen it at that point. Any question? Yes, 6%. Asante. And today I've not seen our assistant rep. No, is it assistant? We have 4 reps. We have 4 reps for FAL, FM, but all of them. Today I've seen Eric and Quinta. Also, Frida is a rep. Ivy, I've not seen Ivy today. Yeah, Frida is also a rep. Yes, good. Oh, sorry for that. Okay, sorry for that, and quick recovery. You see, mwalimu anajua watu wake, si ndio? Yes, I've not seen. Ivy has not even answered more questions. So you'll be okay. Quick recovery, so that you'll be able to catch up with everything. Okay, so that is it for today. Unless there's a question, I just wish to stop at that point. To stop at that point. Let's just edit at that point. Thank you so much for having time to attend our today's session. It's a great sacrifice. We cannot take it for granted. Just keep focusing, keep the commitment, and everything will be okay. If you do what you're supposed to do, there's no doubt for a pass. Continue the group discussion. Make sure that you are attending the group discussion. I think we resolved that you can use the Google Meet. Google Meet does not have the limit. No, when you use the Zoom, which is not upgraded, that one will just go for 40 minutes. Then you start another one, which is disruptive. It is disruptive. Therefore, you can use the Google Meet. But now for the Google Meet, disadvantage is that you cannot be able to do what? To record. It is not possible for you to record. Therefore, it is good that you attend in person. And give apology where you're not able to do what? To attend due to unavoidable circumstance. It is always good, a good manner. It is ethical, right? To be send an apology to the class reps. So I've mentioned we have 4 class reps. Therefore, kindly always be getting in touch with them. They'll be in a position to guide you. So pale mbele mambo iko sawa. Keep working hard. And everything will be well. Asanteni sana na mkuwe na siku njema and a happy weekend. Happy holiday. We have a very long holiday. Kindly make sure that you do something regarding financial reporting, financial management over the long holiday. Tulisema mambo na kusherehekea sana ni after tumemaliza mtihani. So make sure that every day you are having some separate time, some 2 hours, 3 hours, committed to concentrating and understanding what you've been doing in class. Kindly, that will really help you. Goodbye. Tupatane next week. God willing. Group ni yenu, muitumie vizuri. Goodbye.